Time now for our Wall Street Week Daily segment with the host of Wall Street Week, David Weston, joining me right now. And David, you've talked with a lot of people over the last few days who've, I think, provided some really interesting insight about what's been going on with the banking crisis, what's been going on, more importantly, out there in Silicon Valley and the whole venture capital apparatus.
It's Wall Street Week Daily about the banks. Basically, that's what it's been so far. It's always been about the banks. And even today, the regional banks are really suffering, particularly places like PacWest and First Republic. But one of the questions is, what does this do to the ecosystem out in Silicon Valley? Because Silicon Valley Bank was so important for that ecosystem.
And you talk with somebody who was really kind of a focal point of that ecosystem for years, the man who actually led IBM, and now I'm told actually has invested in a lot of startups.
Yeah, exactly. Since Sam Palmisano stepped down as CEO and Chairman, he has been very active in investing in Silicon Valley. He's the head now of the Center for Global Enterprise, and he's the chairman of that. And we talked to Sam not only about what it means for big companies like IBM, but also what it means for some of the startups and the venture capital firms. This is what he said about the investment climate for tech.
The past couple of years, normally what's happened historically, and it'll happen again, is private markets trail the public markets. Whether that's up or down, that's the nature of the beast. And sometimes it's 6 to 9 months thereafter. So everybody felt, going into 2023, it'd be a better year because valuations had come down in the previous periods of time. So it's going to be a more favorable investing environment, albeit on different models than the past. I mean, there was going to be, and there still will be, a rebalancing of revenue as a priority over cash and profitability. That is remixing for sure. But given SVB and the most recent events, I believe, at least the people I work with, are becoming more conservative. And there's consensus that valuations are going to continue to be under pressure.
So from your experience in the past, what does that mean in practice? Does that mean that there are ventures that in an ideal world should be funded? Or does it shake out some of the ones that, frankly, probably never should have been funded?
No, you said it quite well. I mean, there were things that were chasing revenue, and they were rewarded for just chasing revenue. Without that balance, historically, there was always a balance between revenue growth and a path to profitability or a path to cash break even. That got distorted. And, oh, by the way, when money was very inexpensive, or you could argue free, I mean, fundamentally, that drove valuations. And a lot of companies were rewarded for that, not having the best business models, but having a lot of revenue growth. Now, that's changing back to the traditional models, which I would have argued probably should have been even then, which is real businesses, things that are going to not start, obviously, because you're investing, but over time have a credible plan to get to cash break even and some level of profitability. And that's kind of where we are. Having said that, as we look at the world, and many of my colleagues look at the world, we think there are opportunities out there. We really do, but they need to be innovative businesses that are differentiated in tech with seasoned entrepreneurs. We don't think it's time now to go help some kid right out of school, chase a moonshot.
So are there opportunities that are even better than they were before because the valuations have come down? Your entry point is lower, and so you actually can make more of an investment than perhaps you did before this banking crisis.
Yeah, clearly. Clearly. We always try to we try to go in early. I partnered with Jim Breyer and his family, and we've been doing this since I retired. And then after he left Excel, he had a huge hit called Facebook. And so he and his sons work together, and my son also works with us in this world. But we are exactly where you are. We think there's more of an opportunity to get bigger percentages in the early stages than we would have historically because valuations are coming down. And so, therefore, we're willing to take bigger positions. Now, to us, that's an attractive environment to participate in, depending upon the actual entity or the company itself. Their ability to raise cash is going to get tough. There's no doubt if they have to do a round in the short term, it's going to be hard to do. Now, I don't think that'll be the case as we get into next year. But in the short term, if you need a round to maintain viability, it's going to be tough.
There's an awful lot of talk about artificial intelligence and ChatGPT that you mentioned. I worked for somebody you knew well, Tom Murphy, over at Cap Cities ABC. Yes. Tom always used to tell me, I want to be the second into a new technology, not the first. I'd rather have somebody else go in first and figure out what works. Is there that element, you think, to ChatGPT and some of the chatbots? That is to say, we're not sure what will work and what wouldn't. You want to wait and see what's going to sort out.
Well, yes, Tom was always prescient, and I love Tom. He was on the IBM board for years, and he used to always look after me. I was a kid at the time, but he was a great guy and a great mentor for me. Having said that, you're absolutely right. So let's go back to the early days of the internet. If you go back to now in the late 1990s, I know people can't remember that, but let's go back then. It was mostly a lot of usage going on, but a lot of it was just putting your company materials out there or your product information out there. It was sort of a brand awareness, let's say, within the digital world. It took years, maybe 10 to 15 years, to become a totally digital, secure commerce platform. That had to be built out, and there were winners and losers. Obviously, a huge winner was Amazon, as we all know. There were other people like WebMD and others, and these other kinds of pets.com, whatever it was. They went by the wayside, as you might recall. Having said all that, I think it's a similar thing right now. I mean, there's going to be a lot going on. In my little think tank, we do a thing around data provenance called the Data Trust Alliance, and there was 26 major corporations around the world. Nike, Under Armour, CVS, General Motors, Walmart. I mean, I can go on and on and on. But anyway, and we were on our call last week with the CEOs, and basically, they all are putting their toe in the water. But again, if you're in finance or if you're in drug discovery, like a Pfizer is also a member, MasterCard, American Express are members, they have to learn the technology, but it needs to be about 100% accurate. You can't put a drug in the marketplace and not some high level of accuracy, or you can't take financial risk and information without a high level of dependability, which is called data provenance. And so my only point of that is this thing will evolve. If you go back to the patterns of the internet when it first came out, and all that capability will be built. And those small companies or large companies, whomever builds that capability, it represents opportunities for them either to create competitive advantage or get investment returns.